So US markets opened a short time ago for the last trading day of the week. Obviously, momentum has run out this week on that bullish rally, but still looks like we're going to be closing the week towards record highs. A lot of focus at the moment on what's going on with the fiscal package. There's a whole debate about inflation. Will it cause the economy to overheat? Is it too much? Is it not enough? We've discussed it in a couple of videos this week, and I mentioned that we'd bring you an update after we had the talk from Jerome Powell, the chair of the Federal Reserve. We have a clip here from him discussing it. I prefer these discussions when he's not so scripted and he's actually speaking a bit more freely. Although he's obviously always cautious, he has to be as part of his job, you kind of get a better gauge of where he's concerned or not. And it seems that he's very clear on the fact that fiscal stimulus is necessary, it's important. He wasn't going to weigh in on, how much he thinks that there should be, like the total amount of the package or anything like that. So let's check out what it is that he actually said.
Peter, I guess I need to start by saying that the question of how much to spend and what to spend it on, that's really one for Congress and the administration. And there's a discussion going on right now about those precise questions, and that's appropriate. So, but not really appropriate for me or for the Fed really to try to get into that discussion. We have very important goals, and Congress asks us to achieve those goals and gives us independence to do so. But the other side of that is we should kind of stick to our knitting a little bit. So I'm a little reluctant to get into what is clearly a very active debate. I will say a couple things. One, fiscal policy has been absolutely essential in this recovery. This was a very different kind of a downturn, which really, it wasn't that something was wrong with the internal workings of the economy. It just was this really natural disaster hit, and people's incomes in many cases were just extinguished really quickly. So it was about income replacement. It's also now about stimulation of aggregate demand, but it wasn't really about a demand shortfall or some kind of imbalance in the economy. So fiscal policy really came through with the CARES Act and then followed up. And I would just say it is the essential tool for this situation. And we of course will continue to support this as far as for as long as is needed with our tools. I guess I will also say that that measures of potential output there's a wide range of estimates, and I think it's hard to really. I talked about this at Jackson Hole actually a couple of years ago. You want to be careful with relying too much on real-time estimates of potential output or the natural rate of unemployment for that matter, or for that matter the neutral rate of interest. Greg, as you would imagine, we monitor a very broad range of inflation indicators, both in inflation expectations, where we actually have an index of common inflation expectations. So these are survey expectations or market-based break-evens and that sort of thing. Also, of course, PCE inflation is our chosen metric, but we do look at wages and other means. So, of course, it's half of our mandate, and so we have. We do a lot, and we have a very strong group of inflation economists, and it's one of our major focuses. I'll just say, I think the bigger picture still is that we've seen, as I mentioned, 3 decades, a quarter of a century of lower and more stable inflation, and we've seen really the last decade be characterized by global disinflationary forces and large advanced economy nations struggling to reach their 2% inflation goal from below. So that, I think, is the broader setting. In addition, the pandemic itself has produced lower inflation readings, driven at the beginning by collapsing demand for in certain particular services. As we look forward, as the very low readings of March and April of last year fall out of the 12-month window, we'll probably see an increase, but in readings. But that's really not going to mean very much. You're going to see it won't be very large or persistent in all likelihood. It's just a function of those readings falling out. Well, we also may see, as the economy reopens, we may see a burst of spending. We don't know this, but many are monitoring for that. If the economy reopens, there's quite a lot of savings on people's balance sheet. There's monetary policy, there's fiscal policy. You could see strong spending growth, and there could be some upward pressure on prices there. Again, though, Uh, my expectation would be that will be neither large nor sustained. We have had inflation dynamics in our economy for, as I mentioned, 3 decades, which consist of a very flat Phillips curve, meaning a weak relationship between high resource utilization, low unemployment, and inflation, but also low persistence of inflation critically. If you go back to when you and I were in college, um, you had a steep Phillips curve, but you also had the situation where if inflation went up, it would stay up because expectations were not anchored. And so people would expect inflation, and that would make it go up, mean that it went up. So we have very low persistence and a very flat Phillips curve. Now, those things are not permanent. Nothing in the economy is really permanent. It will evolve over time. Inflation dynamics will evolve, but it's hard to make the case why they would evolve very suddenly in this current situation. So the last thing I'll say is you asked about actual inflation. So in fact, if you look at I described our new framework and our guidance. In major part, we are looking at actual inflation. We want to see actual inflation, and part of the reason for that is all during the long expansion, many of us, and that includes me, were writing down a return to 2% inflation and maybe a mild overshoot year after year after year. And year after year after year, inflation fell short of that. So we have tied ourselves to realizing actual inflation. For example, that's the way our rate guidance works. Is we'd have to see inflation reach 2%, not in a forecast, but actually. So we are looking for actual inflation. The last thing I'll say is, of course, if contrary to expectations, inflation expectations were to move up in a troubling manner, and that were to be sustained, or if inflation were to be at troubling levels and that were to be sustained, then we have the tools to address that, and we will, of course, use them.
So no real surprises there. We've now seen from both the Treasury side and the Federal Reserve side that they both think fiscal stimulus is needed, and if inflation does rise, it's something that they can deal with. Now, Jerome Powell pointed out that they'd wait for actual inflation to reach the 2% target before making any decisions, and their preferred measure is obviously PCE, so that's one to keep an eye on. But we've seen things like oil price rising quite a lot. We saw JP Morgan pointing out that they think it's the start of the next super cycle. So we're going to switch our attention a little bit for next week. We're going to start focusing a bit more on oil and commodities. So we'll bring you some updates on that and our views on the oil market next week. In the meantime, I think the next video we'll be bringing out will be looking at the FTSE, so switching our attention to UK stocks, an interesting situation going on there. But if I don't see you before, I hope you have a great weekend. Hope you had a good week in the markets. Things have been successful for you so far this year, and I'll see you in the next video. Thanks for watching. Take care.